Hello, my name is Victor Uribe. This is part 2 of our investment series, with our main objective being educating new investors or people who have heard a lot about investing but have been a little bit uncertain of where to begin and how to get the ball rolling. This playlist is meant for you in particular, so if you haven't already, please check out the previous video where we just talk about the specific assets. And some of the risks that kind of go into it. But in this one, we're just going to be specifically talking about specific accounts. Um, uh, we won't be showing you how to actually open them. I will make separate videos on how actually creating these accounts. I don't just want to leave you with the information and not help you actually create these accounts and actually get the ball rolling. That is one of the things that I really do want to push. But for now, we'll just go over the accounts. Okay, so everyone has heard about the Roth IRA. Genuinely, everyone has. But one thing I want to preface is that a Roth IRA is a shell, a vehicle, if you will, with tax advantages. So technically, you could put in your money in there, and it wouldn't grow. It'd just be a bank account with zero interest, zero nothing, and you'd get nothing from it. In that specific account, these accounts basically allow you to invest, and you still have to choose sound investments in the Roth IRA for it to grow. And one of the things that I will say with the Roth IRA in particular, it is non-taxable at the end when you pull the money out, because the money that you make off of your paycheck is already taxed. So when you put in that money that has already been taxed into the Roth IRA, you already pay taxes on it, so when you withdraw it, you're not paying taxes on it. I will say there is something called a traditional IRA, which works in reverse, in the sense that you basically, when you contribute money to it that's already been taxed, right? You will have to report it in your taxes, and they will give you a reimbursement. Because you will pay taxes for the traditional IRA when you withdraw the investments from your account. Cool. Now that we got that kind of cleared and out of the way, then we'll talk about contribution max for 2024. That is $7,000, and it typically tends to go up yearly by $500. This goes for both Roth IRA and traditional IRA. And one thing that I do want to talk about really quick is there is an aggregate $7,000 between both of them. So either you can contribute $7,000 to, say, for 2024 at least, into the Roth IRA, or $7,000 to the traditional IRA. In aggregate, it has to be $7,000 max in between both of them. So it's either do you want to pay taxes now, or do you want to pay taxes later? It's up to you. I personally would rather pay taxes now, since it will probably be more expensive later, or taxes would just be higher later. So I typically would tend to go for the Roth in this case. Anyways, but the one thing is, with most retirement accounts, you do have to wait until you're 59 and a half until you can pull the money out without any penalties. If money is pulled prior, you will be taxed at least 10%. And one thing I really do want to put out there as well is there are circumstances where you will not pay, or you can withdraw without penalty. That would be for extreme emergencies, like medical emergencies, and like your first-time house buyer. If you're a first-time house buyer and if you want a good down payment, you can withdraw from it. There are also others. Please just Google search them. If you do want me to leave a link to the presentation here, I can leave them in the comments. Just please comment down below, and I'll do that. Anyways, the thing that I'm trying to express is you shouldn't feel like it's going to be locked in there no matter what. Obviously, if you're going through a hard time and you can make by, if you can make by without withdrawing the money, probably leave it in there. It's just you don't want to break that compound interest accumulating, right? And then we will go to individual broker. An individual broker is just a broker where that would have been dumb to explain it that way. It's just a platform where you can buy stocks and stuff, where you can actually invest in general. For a particular individual broker, you cannot, or there is no tax benefits like there is a Roth IRA, traditional IRA. They technically, those accounts are part of a brokerage, that being Charles Schwab, Vanguard, BlackRock, stuff like that. But for the individual brokerage account, there's zero tax benefits. So like whatever profit you make, you will automatically pay taxes on that when you sell. In the case of a Roth IRA, you wouldn't pay taxes on that at all for the gains that you make. Anyways, going on. Treasury Direct. This isn't an investment account. Technically, it's more of a platform where I would suggest you make an account to, where it basically allows you to buy fixed income securities directly from the government, that being treasury bills, bonds, stuff like that, directly from the government. And these are typically seen as the safest investments possible, because the only way that the government doesn't pay you back is when the government ceases to exist. And if that happens, your dollar is worthless anyways, right? So there's that. Okay, we'll kind of go here. And one of the things that why I'm a big fan of treasury bills is because you might go to a high yield savings account, but the one thing with high yield savings account, whatever money you make off the interest of your money being accumulated in there, one of the things is that you will have to pay taxes for federal and state taxes, so for both of them. But the one good thing is you will be pretty liquid to a certain degree. What I mean is all your money is going to be there if you actually need it. With Treasury Direct, or when you invest in treasury bills, it depends on the duration that you invest in. So for example, 4 week, I personally like investing in 4 week T bills. I'm just pulling up the rate really quick, apologies. Okay, so let's just kind of take a look at these. Yeah, so like a 4 week bank, it's like trading at like 5.28% interest rate. No, when it comes to interest rates, or any percentages, or most of the rates in finance and investing, it is annualized. So that 5.28 that we're seeing here, for your monthly payout for this particular investment would be 5.28. Divide that by 12 times the amount that you are investing. And note, when it comes to treasury bills and bonds, your money is withdrawn from your account, and then after the maturity date has occurred. So like say the maturity date in this case for the 4 week bond, or treasury bill, would be after 4 weeks you get your money back, right? And here we see a discount. So what that means is, let's say you put in $5,000, you decide to invest $5,000, and from your account what you will see is that they withdraw $4,980, and then by the end of 4 weeks they will give you back $5,000. And one of the things that I will say about treasury bills, they do pay you a bit more, but you also only pay taxes for federal, as I stated before. And one of the things that you do have to watch out for is you have to leave and be very mindful of the amount of money that you actually contribute, because you also should account for bills that you have to pay and leave a little bit more cushion room in case of any emergencies. So it's just one of those things that you have to put a little bit more mind into, but you can also create more. I'm going to explain ladders in a bit, sorry. It's a investment strategy when it comes to fixed incomes, but I should first explain that you will see that the interest rate for longer durations give you less of the yield. So say, if, for example, for 52, a year-long treasury bill, meaning that you will get your money back after 52 weeks, right? So you're not going to be that liquid. You're going to have a 4.57 rate, whereas you have the for the 4 week one, you have a 5.28, which, yes, it's more, but it's technically not locked in, meaning that this 5.28 like next week, or in, let's say, not even next week, like next month, right? The discount rate, it could drop to, like, let's say a 3, right? So it's technically not realized 5.28 annualized, right? Because you have to do that annualized, because basically the way that you take the actual return of these is however many you buy in a year. So let's say, for example, in January we buy a 4 week treasury bill for 5.28, and then for and then let's say like a month later, it just, well, these are all pretty consistent, sorry. It's just basically the average of all the treasury bills that you buy. That is your actual return, because you have to remember, you have to like bring it back to an annualized rate of return. That's the best way I can explain it right now. Apologies if that confused you. I just tend to ramble a lot. But in general, you tend to see the longer durations typically a little bit lower rate, just because you will technically actually realize these rates, like especially for the 52 week. So what you're actually buying is the 4.57 rate completely annualized. Like, you're guaranteed that if you don't sell it, you're guaranteed that payout and rate for the 52 weeks. But then again, you're not that liquid. You will receive that at the end of the year, though. Instead of dividing it by 12, you technically would just, like for the 52 week ones, you'll just straight up get 4.57% back at the end of the year when the maturity date hits. And what I was trying to say with the ladder strategy is, you can technically mix the duration. So let's say you could have a 4 week, like, of whatever amount of money that you have. If you put, let's say, like, if you want to be pretty liquid, let's say you do a 70-30 split. So you do 70% of the money that you're trying to invest in treasury bills into the 4 week one, and then you do 30% of the 52 week one. So you do lock in, let's say, for example, the most recent one would be all the way at the bottom. Yeah. It would be like, you would automatically like actually lock in like a 4.58%, plus potentially a little bit more with the 4 week ones, if they do tend to stay at that 5.29%, right? Anyways, I think it's a great alternative, but you do have to be mindful of it. I will talk about investment strategies now really quickly. I won't try to take up too much of your time. So I always stick to index funds. Just beginning, if you're just beginning, don't try to invest in single stocks. Yes, higher risk, higher reward, but also you have the higher potential of just straight up losing your money. If you buy into index funds, they tend to perform a little bit more. Later on with this channel, I plan to actually do more portfolio analysis. If you guys would want, I am pretty familiar with like actually calculating the returns or performance returns on portfolios, and it could do that if you guys are interested in actually finding like what index funds are actually worth it, right? But for now, we'll just kind of keep it simple and go through it. So the one I always recommend is VO. One thing I will note is that Vanguard, the creators of this particular fund or ETF, VOO, they are known for their low expense ratios. One thing that you should always pay attention to is your expense ratio, is because it can diminish your returns in the long run, and it can very much ruin your compound interest depending on how much they're charging you. That's why I'm very mindful with even financial advisors. Yes, they're good, just make sure that you know their fees. That is very, very, very important, because that could be the one thing that is like ruining your retirement, right? You're just not going to get more bang for your buck in your actual investments if someone's eating away at your portfolio, right? It's just not great. So I always recommend VOO. It tracks it's an S&P 500, or it basically tracks the S&P 500. It's a replica of it, and what the S&P 500 is, it's the 500 most valuable companies in the United States, and overall they tend to perform pretty well. These, especially with the tech bubble, it's just been going crazy, but it has pretty good returns. I'm pretty sure the average has actually been increasing. It might be like a 13 to 14% now. I'd have to rerun those numbers, especially since everything's kind of crashing as of today right now, because it's it's 7:30, where Nvidia is kind of crashing towards like 100. Um, and just kind of, I want to talk about just retirement very, very quickly. Overall, just kind of big steps in planning. One of the reasons why I also want you guys to make a Treasury direct account, just to get familiar with the actual investing. The reason why is because what you should kind of try to go towards is whatever you have in your Roth, you want to withdraw and then put it into your Treasury account and do the fixed income to, help you create that fixed income aspect to your life, because once you retire, you do want some money coming in, and then you won't really need much growth in your portfolio. So the way I think about fixed income is to sustain your wealth, while investing into the market, especially like S&P 500, stuff like that, and actual stocks is for growth. You're looking to grow your money so then when you retire, you can sustain your money. And in that aspect, because if you take advantage of a Roth IRA, you can withdraw all tax-free, and you have a big lump sum, which then you can invest into Treasury bills, which will give you a little bit more, a decent amount of money. And when it comes to your individual accounts and your traditional accounts, like accounts that have a where you get taxed when you withdraw, you should be very mindful into only withdrawing exactly what you need. Do not try to withdraw all of it, because you will have so much of it taxed, and it's just going to be a pain. And one of the things that I want to kind of calculate really quick, sorry, I'm looking at my phone. So let's say if you have, let's just kind of looking at the interest rates, a 10-year bond was, actually, let's not guess. Let's go over 10-year bond. This is good. Like when you retire, you might want to do 10-year bond. The 10-year bond is currently trading at 4.14. We'll just do that for our calculations really quick. So let's say from your Roth IRA, you might have $1,200,000. Times 4.14%. So yearly, that's like 50K for off of a 10-year Treasury bill. If you had $1,200,000 in your Roth IRA, so that is money that would then just be very useful in you sustaining your life. And obviously, the more you have, the better it is. But it's just something to kind of keep in mind. Obviously, I'm not your financial advisor. Everyone's life is different. Please keep in mind. And when you do buy as a very first investor, or if it's like your first time investing, when you invest, just buy and hold. And when I say that, just do it with the S&P 500. It's one of the safer bets. Just buy and hold it, and just pretend like it doesn't exist anymore. When you put money into your Roth IRA, just pretend like it doesn't exist anymore, right? You don't want to be sitting there looking at your account all day. It's just kind of like there's no point in it, since you shouldn't be withdrawing from it, right? It's nice to see it go up, but at the same time, it's going to be pretty bad sometimes, because it might drop down from all-time highs a little bit, but next year it'll just come back up. So it's one of the things is be patient. This isn't a get rich quick scheme. It's more of a looking out for your future self plan, and just taking baby steps to actually get yourself there. You shouldn't be targeting these 40%, 50% investment returns. You should just be looking for very consistent returns that do give you something, right? But anyways, do please comment, like, and subscribe. I do want to keep on making more videos, and if I have helped you out and helped you gain a little bit more insight about investing and actually hopefully getting you out there and doing it for your own retirement, please uh, please share it with a friend. Be very much appreciated. Take care.